Why is it that most people who start trading never make it to the finish line? Why do they pour in their hopes, their money, their energy, and still end up walking away, frustrated and defeated? The pattern repeats itself so predictably that if you spend even a little time in trading communities, you'll see it everywhere. New faces pop up full of energy, posting wins, talking about freedom, showing screenshots of profits. Fast forward a few months, and those same faces are gone, disappeared without a word. The cycle is so common it feels like the market itself is designed to break people down. But the truth is, the market isn't the reason they quit, it's what happens inside them. Most people come into trading with fantasies instead of a plan. They don't see the market for what it is, they see it for what they want it to be. They see a shortcut. They see a fast escape from bills, debts, jobs they hate, responsibilities they want to run from. Trading gets marketed as the golden ticket, and people buy into the dream. They imagine a life where money flows with a few clicks, where their phone becomes an ATM, where their friends look at them with envy. And at first, it feels like that dream might actually be real. On a demo account, everything looks easy. You buy, it goes up, you sell, it goes down, and you feel like you're already ahead of the curve. That little rush of confidence is enough to make you believe, I've got this. Now picture a young man named Musa. He's 22, restless, ambitious, tired of watching his parents struggle to pay rent. One night, scrolling through Instagram, he sees someone posting screenshots of $1,000 made in a single day. That number burns into his brain. He doesn't even know the details of how it's done, but he knows one thing: if this stranger can do it, then so can he. The next day, Musa downloads MetaTrader, funds his first account with $50, and jumps straight in. At first, luck is on his side. He doubles his account in a week. He's euphoric. He can't stop smiling at the thought of turning $50 into $500, then $5,000, then a fortune. He starts daydreaming of cars, houses, vacations. But then the market reminds him of the truth. A trade that looked perfect turns against him. He adds another position, hoping it will reverse. It doesn't. He doubles his lot size to make it back. Within 2 hours, his account is gone. He feels sick, angry, confused. Instead of stopping, he deposits again, convinced he just needs one good trade to recover. But the same pattern repeats. Loss after loss, deposit after deposit, until his small savings are gone. In a few weeks, his excitement turns into despair. Musa throws his hands up and says, "Trading is a scam." And just like that, another trader quits. But here's the truth. Musa's story is not unique. It is the default journey for almost everyone who steps into the market. The difference is not in whether you experience it, but in how you respond when you do. The traders who eventually succeed face the same pain, the same losses, the same temptations to give up. The only thing that separates them from the ones who quit is endurance. They keep going when others stop. They survive long enough to learn the lessons most people never stick around to understand. So why do most traders quit? One reason is that they walk in with the wrong expectations. They think trading is quick money, when in reality it is slow mastery. They believe success is a matter of finding the perfect strategy, when in truth it is about learning to control yourself. The market is not a get-rich-quick machine. It is a mirror. It reflects back to you your patience, your discipline, your greed, your fear. If you are reckless, the market punishes you. If you are disciplined, it rewards you. But discipline takes time to build, and most people are not willing to wait. Another reason traders quit is the emotional weight. The stress of watching your account balance rise and fall is heavier than it looks from the outside. People think they can handle it until they feel it for the first time. One day you make $200 and feel invincible. The next day you lose $300 and feel like a complete failure. The highs and lows pull at your emotions like a violent storm, and if you don't have a solid anchor, you get swept away. Eventually, the exhaustion is too much. They tell themselves it's not worth it, and they walk away. But here's the cruel irony. The point where most traders quit is often right before the breakthrough. Trading is like digging for gold. At first you're excited, swinging the pickaxe with energy, but after hours of digging, your arms ache, your back hurts, and you still haven't struck anything. Most people drop the pickaxe and walk away. What they don't realize is that the gold was just a few feet deeper. In trading, the gold is consistency. It doesn't show up in your first month, or even your first year. It comes slowly, after you've survived enough mistakes, enough setbacks, enough painful lessons. But since most people quit too soon, they never get to see it. Imagine if Musa had kept going. Imagine if, instead of quitting, he slowed down, studied his mistakes, practiced discipline, and treated trading like a skill instead of a lottery. Within a year or two, he could have built consistency. Within 5 years, he could have mastered his craft. But he didn't last long enough to find out. And that's the story of most traders. They leave just before the transformation. Trading success is not about being the smartest, the fastest, or the luckiest. It's about being the one who stays in the game. Every profitable trader has scars from the early days. They remember the blown accounts, the sleepless nights, the shame of losing money they couldn't afford. But those experiences shaped them, taught them patience, and made them strong enough to handle the pressure. The ones who quit never gave themselves that chance. So when people ask, why do most traders fail? The answer is simple. They quit too soon. They let pain convince them to stop instead of letting it push them to grow. They wanted success faster than reality could give it to them. And when it didn't arrive on their timeline, they walked away. The real tragedy isn't that trading is hard. The tragedy is that people give up right when they were closest to making it work. Because if you strip everything away, the market only rewards one thing: time in the chair. The longer you stay, the more you learn. The more you learn, the better you become. And the better you become, the closer you get to consistency. It's not glamorous, it's not instant, but it's the truth. So the next time you feel like quitting, remember this: the market is testing you. Every setback is asking you a question. Do you really want this? Or do you just want the idea of it? Most people answer by walking away. The few who answer by staying eventually find the success everyone else gave up on. And that is why most traders quit before they succeed. Most traders don't quit because they lack intelligence or because they can't learn a strategy. They quit because they cannot survive long enough to allow their growth to happen. Trading is not about brilliance in the moment, it's about durability over time. Yet most people enter this game with the exact opposite mindset. They want quick wins, fast profits, immediate results. They don't realize that the people who succeed in trading are the ones who last the longest. They outlast the struggles, the blown accounts, the psychological pain, the endless uncertainty. That endurance becomes their advantage. The majority quit long before they reach that stage. Think about how traders usually begin. The excitement is fresh. They discover the financial markets, maybe from a YouTube video, maybe from social media, maybe from a friend who bragged about a quick win. It looks like freedom, like wealth, like an escape from a job or financial struggle. That excitement pushes them to open a demo account or even go straight into a live account. At first, they might win. Luck often favors beginners for a short time, and that makes them believe they are natural traders. They double down on risk, they trade more frequently, they ignore risk management. Then, inevitably, they lose. They don't just lose money, they lose their emotional stability. That first sting creates a fork in the road. Learn from the loss or spiral down into self-destruction. But the truth is, most don't learn. They jump from strategy to strategy, indicator to indicator, hoping the next one will be the magic fix. They never give themselves enough time to master one approach, to let probabilities play out. When losses come, they blame the system, the broker, the news event. Rarely do they look inward. And that's why they quit. Not because the market was too difficult, but because they refused to develop the patience to endure the losses that are part of the game. They thought trading was supposed to be a constant upward slope, when in reality it's a series of rises and falls, like waves on the ocean. You don't quit the ocean because of the waves, you learn to swim with them. One of the most overlooked truths in trading is that failure is part of the path. Every professional trader you admire has blown accounts, made catastrophic mistakes, lost thousands. The difference is that they kept going. They saw every failure as tuition for their trading education. Meanwhile, most people interpret failure as a final judgment on their abilities. They say, "This isn't for me. I'm just not cut out for this." And they walk away, never realizing that the failure was not a dead end but a step they were supposed to climb. The reason why most traders quit before they succeed is because they misinterpret the meaning of failure. Imagine two traders with the exact same level of skill. One loses $500 on a bad trade. He thinks, "This proves I don't know what I'm doing. I'm wasting my time. I should quit." The other trader loses the same $500 and thinks, "This is frustrating, but what did I do wrong? Was it my entry? Was it my position sizing? Was I trading emotionally? If I can find the mistake and adjust, then this loss is worth it." The second trader treats the loss like feedback. He doesn't like it, but he uses it to sharpen his edge. The first trader treats it like a verdict. He lets it define his identity as a failure. That's the difference. Same chart, same skill, same result, but opposite mindsets. And that mindset determines who survives. Another reason traders quit too soon is because they underestimate the time it takes to become consistently profitable. If you look at other professions, doctors, lawyers, engineers, it takes years of study and practice before you earn a reliable income. Yet traders come into the markets expecting consistent profits in 6 months. They don't treat trading as a profession. They treat it as a lottery ticket. That unrealistic timeline sets them up for disappointment. When consistency doesn't come fast, they feel like they're wasting their time. The truth is, trading requires years of practice, just like any skill. If you're not willing to dedicate that time, you'll quit. And ironically, you'll often quit just before you are about to make the breakthrough. This phenomenon is seen in countless traders' journeys. They grind for months, maybe a year, fighting through setbacks, slowly improving their discipline. They're right on the edge of mastering their emotions, of finally creating a system they can trust. But right at that critical moment, the pain of losses weighs too heavily. They look at the account balance, they look at their time invested, and they think, "This is going nowhere. I give up." What they don't see is that they were inches away from the shift that separates losers from winners. Most people quit at the valley, never realizing the mountain was right ahead. There's also the issue of ego. Many traders quit not because they don't have the potential, but because their ego cannot handle being wrong over and over. In trading, you will be wrong often. You will lose trades. You will misread setups. You will get stopped out. For those who need to be right, this is unbearable. They can't stomach the idea of looking foolish, of admitting mistakes, of facing the reality that they don't control the market. Their ego pushes them to revenge trade, to double down, to chase losses. And when that fails, their ego pushes them out of the game completely. They'd rather quit and blame the market than stay and admit they have more to learn. Meanwhile, the trader who humbles himself, who accepts being wrong as part of the process, survives. And survival is the name of the game. Fear also plays a huge role in why most quit. The fear of losing money, the fear of looking stupid, the fear of wasting years chasing something that might not work. Fear whispers in their ear after every losing trade, saying, "You're not cut out for this. Quit before you lose more." That fear kills more trading careers than any lack of knowledge. Because here's the truth. If you stay in the game long enough, you will learn, you will improve, you will find your rhythm. But if you let fear drive you out, you'll never get there. Quitting is permanent. Fear makes temporary pain feel permanent, and that illusion causes people to give up. Think of the stories of legendary traders. Almost all of them experienced deep failure before success. Some lost millions before they figured out risk management. Others blew account after account before developing discipline. Their journey was ugly, messy, painful, but they didn't quit. That's why we know their names today. The ones who quit never get remembered. Their stories disappear into silence. Success in trading is not reserved for a chosen few. It's reserved for those who don't walk away when it hurts. There's another subtle reason many traders quit. Comparison. They look at social media and see other traders posting screenshots of big profits. They feel behind, inadequate, like everyone else has figured it out but them. They don't realize that most of those screenshots are cherry-picked or fake. They measure their beginning against someone else's highlight reel, and of course, they feel like they're failing. That constant comparison drains motivation. It convinces them that they'll never catch up, so why bother continuing? If they only focused on their own growth, they would realize they're making progress. But comparison blinds them, and in that blindness, they quit. And then there's impatience. Trading requires a long, slow buildup of habits, journaling trades, analyzing mistakes, refining strategies, controlling emotions. These things don't produce instant gratification. They feel boring, repetitive, unglamorous. Most people don't have the patience for that. They want excitement, the adrenaline rush of fast profits. When the grind of real trading sets in, they get bored or discouraged, and they quit. The ones who succeed are those who fall in love with the process, not just the outcome. They enjoy the learning, the discipline, the daily growth. That patience keeps them in the game long enough to see results. The tragic part is that most people quit just before success begins to compound. Trading mastery doesn't grow in a straight line, it's exponential. For months or years, it feels like you're going nowhere, just circling the same mistakes. But eventually, the lessons click. The discipline hardens. The strategy becomes second nature. Then consistency starts to appear, slowly at first, then more and more. If you quit too early, you never reach that compounding stage. You never get to experience the payoff of all your struggle. You endured the pain but walked away before the reward. So why do most traders quit before they succeed? It's not because the market is unbeatable. It's because they misjudge the process. They think losses mean failure, when in fact losses mean education. They think time spent without profit is wasted, when in fact it's laying the foundation. They think their struggles are unique, when in fact every trader faces them. They think success should come fast, when in reality it comes slow. And because of these misjudgments, they give up. The ones who don't quit, the ones who survive, discover that success was always on the other side of persistence. If you are reading this, the lesson is simple. Don't quit too soon. The pain you feel, the frustration, the doubt, it is not proof that you're failing. It's proof that you're in the process. Every great trader felt the same emotions. The difference is, they stayed. They endured. They kept going when others walked away. If you can do that, you'll eventually reach the place where consistency lives. The market doesn't reward the smartest. It doesn't reward the luckiest. It rewards the ones who refuse to quit. If you've made it this far, I really need your help with a decision. This channel is growing much faster than I ever imagined. And honestly, I'm so grateful for all of you. When I started this channel, my only goal was to help traders like me who struggle with trading psychology, to give us a place to learn, grow, and get better together. But now I've been thinking, what if we take it one step further? Imagine a private Discord community where we can connect in real time. Beginners, experienced traders, even professionals. A place where we can share strategies, break down our analysis, learn from each other's mistakes, and most importantly, master trading psychology together. Now, here's the thing. I don't want it to be free. Not because I want to sell you something, but because most people don't value what they get for free. That said, it would be very, very affordable. I'm not selling a course. I just want to create a serious, supportive community that can help all of us level up as traders. But I haven't decided yet. That's why I want to hear from you. Should we go ahead with it? Drop your thoughts in the comments. I'll be reading all of them. Now, let's get back into it. Most traders who quit don't realize that trading is a mirror. It doesn't just reflect the market. It reflects your mind, your emotions, your habits, and even your fears. When they look at a losing trade, they see failure. When they experience a streak of wins, they feel invincible. The market doesn't care about either. It doesn't reward your feelings or punish your emotions. It simply moves according to supply and demand, probabilities, and timing. The problem is, humans are wired to respond to what they feel rather than what is happening objectively. That wiring is what destroys the majority of traders before they ever reach success. Take impatience. Most people don't quit because they don't know how to trade. They quit because they expect immediate results. They see a month of small losses and think, I'm not cut out for this. They don't give themselves enough time to understand the process, to build discipline, to cultivate the mental edge that separates consistent traders from the rest. Trading mastery doesn't happen overnight. It's forged in long nights of studying charts, making small errors, journaling mistakes, and refining strategies. But impatience makes them abandon that process. They quit before the foundations of success are fully built, leaving potential unrealized. Fear is another silent killer. Every losing trade triggers a rush of emotions: anxiety, anger, regret. That fear creeps into the decision-making process, convincing the trader to act irrationally. They reduce their position sizes excessively, avoid opportunities, or stay out of the market entirely. Fear doesn't just reduce profits, it destroys confidence. And when confidence is gone, quitting seems like the only logical option. Most traders never understand that fear is a normal part of trading. It's a signal, not a verdict. Those who survive learn to use it as a guide, not a weapon against themselves. They accept it, analyze it, and adapt their strategies accordingly. That's what separates the survivors from the quitters. Then there's overconfidence, the other side of the emotional coin. Beginners often experience a few lucky trades and start believing they have figured it out. They ignore risk management, they increase trade sizes, they chase profits, and inevitably, a single loss wipes out their gains, or worse, blows the account entirely. Overconfidence, just like fear, is a psychological trap. Both extremes, fear and arrogance, push traders toward quitting. They either get scared out of the game or crash out of it. Balance, patience, and discipline are the antidotes, but most people never discover them because quitting happens first. Many traders also quit because they fail to distinguish between effort and results. They believe that if they're working hard and spending hours studying charts, success should arrive immediately. When it doesn't, frustration builds, and quitting feels like relief. But in trading, effort doesn't always correlate with immediate results. The market doesn't owe you anything. It doesn't reward preparation instantly. It rewards consistency over time. The trader who understands this continues refining their skills even when results are delayed. The one who confuses effort with immediate outcomes quits, thinking the game is unfair, when in reality, the problem is a misunderstanding of timing. Another critical reason traders quit is that they attach their identity to every trade. They make a trade, it loses, and suddenly they feel like a failure as a person. They identify with the money, the positions, the account balance, and when it declines, so does their sense of self-worth. Trading becomes a mirror reflecting not just the market, but their deepest insecurities. This emotional entanglement is deadly. It creates a feedback loop where losses trigger despair. Despair leads to poor decisions, and poor decisions lead to more losses. Eventually, quitting feels like the only way to escape the negative spiral. Successful traders learn to separate their identity from each trade. They see every entry and exit as data, as probabilities in action, not a measure of their value as a human being. Comparison also plays a role in driving traders away. Social media paints a distorted picture of reality. Beginners see screenshots of massive profits, think everyone else is winning, and feel inadequate. They don't see the countless losses, the months or years of struggle, or the failures behind those highlighted successes. This illusion of everyone else's perfection fuels impatience and self-doubt. They start to believe that they'll never measure up, so quitting becomes a way to escape embarrassment or perceived failure. But those who persist understand that trading is a deeply personal journey. Progress is measured individually, and comparison is a trap that leads directly to abandonment. Financial pressure is another hidden factor. Many traders start with money they cannot afford to lose. That pressure amplifies every emotion: fear, greed, frustration, and anxiety. A small loss feels catastrophic. Every market fluctuation becomes unbearable. They are trading under stress, not under discipline. Stress distorts judgment and amplifies emotional responses. It pushes traders toward irrational decisions and, eventually, quitting. Traders who survive either start with capital they can afford to lose, or cultivate psychological resilience to withstand the inevitable swings without letting them define their actions. Quitting also happens because traders underestimate the cumulative power of small improvements. Trading is not about making the perfect trade every time. It's about making slightly better decisions more often than the last day, the last week, or the last month. Those who focus only on immediate perfection get discouraged by mistakes. They fail to recognize that gradual refinement compounds into mastery over time. Quitting occurs because impatience and perfectionism blind them to the incremental progress that eventually leads to consistent profitability. Then there's the lure of easy alternatives. Trading is difficult. It requires patience, discipline, and emotional mastery. Meanwhile, other paths in life, jobs, online hustles, short-term schemes offer immediate, visible results. Traders get distracted by these alternatives, comparing the struggle of trading to the simplicity of other endeavors. They see instant gratification elsewhere and decide to abandon the long-term path of trading for the short-term satisfaction of easy wins. This is a key reason why quitting is so common. Trading demands delayed gratification, and humans naturally resist it. The most tragic reason traders quit is that they fail to build a support system. Trading is isolating. When emotions run high and the market fluctuates unpredictably, there is no teacher or guide standing over the shoulder to provide reassurance. Without mentorship, guidance, or a community to lean on, the psychological burden becomes unbearable. Many traders quit simply because they feel alone, misunderstood, and unsupported. Those who survive either find mentors, join communities, or develop a mental framework strong enough to handle the isolation without crumbling. Support is a hidden, yet essential ingredient in long-term trading success. Finally, the overarching reason most traders quit before they succeed is that they fail to embrace the process. Trading is a long, iterative journey of trial, error, reflection, and adaptation. It is not about the immediate results. It is about growth, refinement, and resilience. Every loss, every frustrating week, every blown account is part of a hidden curriculum teaching lessons the trader cannot learn in any other way. Most people do not appreciate this. They focus on outcomes instead of growth, short-term results instead of long-term skill. Quitting feels like relief, but it is actually surrender to a process they do not yet understand. The ones who succeed embrace the process. They persist when it hurts. They continue when nothing seems to work. And that persistence is what ultimately creates consistent profitability. If you are reading this, take it as a wake-up call. The market is not the enemy. Losses are not evidence of failure. Quitting is not necessary. What is necessary is patience, resilience, discipline, and emotional mastery. Those who endure, those who continue to show up despite fear, doubt, and frustration, are the ones who will succeed. Trading is a test of character, a test of endurance, and a test of persistence. It is not about speed. It is about who can withstand the journey and keep going long enough for the compounding of knowledge, discipline, and skill to reward them. The market doesn't reward the quitters. It rewards the survivors. And that is why most traders fail, because they quit before success has a chance to find them. The cruel irony of trading is that the moment most traders are on the verge of a breakthrough, they quit. They fail not because they cannot trade, but because their mind convinces them that quitting is safer, easier, or more reasonable than persistence. Every trader hits a point where frustration peaks, losses pile up, and confidence is shaken. It's at this exact point that the winners separate from the quitters. Those who persist understand something most beginners don't. Trading is a mental game long before it becomes a financial one. The charts, the candlesticks, the patterns, these are just tools. The real battlefield is inside your mind, and quitting happens when you surrender that internal fight. Think about the trader who has lost 3 consecutive trades. On the surface, it's easy to blame the market. It's manipulated. It's unfair. I'm unlucky. But these thoughts are excuses, distractions from the real issue. Their mind has shifted from disciplined execution to emotional reaction. Quitting becomes a tempting solution because it alleviates the immediate discomfort. It promises relief, but it destroys potential. The profitable trader, the one who survives, sees the same streak differently. They see data, probabilities, and patterns in motion. They see that losing streaks are part of the process, unavoidable and temporary, not a verdict on their ability or worth. That subtle shift, viewing loss as information rather than judgment, is the mental pivot that allows perseverance. Another reason traders quit is that they fail to accept uncertainty. The market is inherently unpredictable. Every trade comes with risk. Yet, humans crave control. We want certainty, outcomes that align with our desires, proof that our choices are correct. When reality does not meet expectation, frustration grows, and quitting feels justified. The survivor, however, learns to embrace uncertainty. They accept that loss is inevitable, that no trade is guaranteed, and that the only controllable factor is their execution, discipline, and emotional response. Once they internalize this truth, fear loses its power, and quitting loses its appeal. Many traders also quit because they fail to develop a routine that strengthens resilience. Trading is not a sporadic skill, it's a habit. Those who treat it casually, who skip journaling, analysis, or preparation, leave themselves vulnerable to emotional erosion. When a bad day hits, there is no mental buffer, no foundation of discipline to absorb the impact. Quitting becomes a coping mechanism. Successful traders understand that the daily grind, studying charts, reviewing trades, reflecting on mistakes, is what builds an invisible armor. That armor prevents emotional reactions from dictating behavior and transforms setbacks into lessons rather than triggers for surrender. Expectation management is another subtle factor. Beginners often start with unrealistic goals. They envision six-figure profits in months, compounding their account exponentially without errors, without setbacks. The reality is brutal. Losses happen, progress is slow, and emotional turmoil is constant. When expectations collide with reality, disillusionment sets in, and quitting appears rational. Profitable traders, on the other hand, align expectations with reality. They understand that consistency, not speed, is the key. They focus on gradual improvement, trade by trade, week by week, rather than chasing immediate glory. This alignment between expectation and reality is a mental shield that prevents premature quitting. A common pattern among those who quit is obsession with outcomes rather than process. Every trader wants results, profits, account growth, visible wins, but obsessing over outcomes creates anxiety. Each losing trade becomes a personal failure. Each market fluctuation feels catastrophic. Quitting feels like a relief from this pressure. The successful trader flips the perspective. They obsess over execution, over following their rules, over mastering risk management. They understand that if the process is correct, results follow naturally over time. Losing the process is far more damaging than losing a single trade, and yet, most beginners never realize this. Isolation amplifies quitting tendencies. Trading is a lonely endeavor. Many beginners have no one to share their fears, their frustrations, or even their triumphs. Without support, self-doubt grows unchecked. Every mistake feels like confirmation that they are incapable. Every small loss becomes unbearable. Those who survive find ways to counter isolation, mentorship, communities, forums, or even disciplined journaling that allows them to track growth objectively. Loneliness magnifies fear, but structured support provides clarity and courage. Quitting rarely happens when guidance and community are present. Greed is another hidden driver. Traders see opportunities and imagine all the potential profits they could make if only one trade worked perfectly. They over-leverage, they chase setups, they abandon risk rules. Inevitably, losses compound, and the dream of quick success shatters. Frustration mounts, and quitting feels like the only escape. Yet, it is the same greed that blinds them to the slow, compounding power of consistent, disciplined trading. Survivors learn to trade without attachment to immediate gains. They accept that wealth in trading is built slowly, quietly, and methodically, not by chasing fantasies. Self-sabotage often masquerades as quitting. The trader tells themselves, "I need a break. I'll start fresh later. This isn't working for me." These rationalizations feel reasonable, even responsible, but they are mental tricks to avoid confronting fear, frustration, and failure. Traders who quit rarely see that they are actively choosing defeat disguised as a pause. Those who endure recognize these patterns and confront them. They distinguish between necessary breaks for mental clarity and excuses to escape discomfort. The discipline to persist through mental resistance separates the quitters from the achievers. The compounding nature of quitting is subtle, yet devastating. Every time a trader quits, they reinforce the idea that failure is permanent, that persistence is optional, that they are incapable of enduring the process. That neural pathway grows stronger with each surrender. Over time, quitting becomes a habit, not an anomaly. The survivor, however, rewires the mind to embrace challenge. Each setback is a teacher, each loss a stepping stone. Persistence becomes ingrained, almost automatic. That mental conditioning is what allows them to eventually reach levels of success that quitters will never see. Perhaps the most overlooked factor is self-awareness. Many traders never take a hard look at themselves. They fail to analyze emotional triggers, decision-making patterns, and cognitive biases. Without self-awareness, errors repeat endlessly. Frustration escalates. Quitting seems like the only solution because the root problem is invisible. The trader who develops deep self-awareness identifies the triggers, understands their emotional patterns, and implements countermeasures. They transform reactive behavior into proactive decision-making. This self-knowledge is invisible to outsiders but absolutely critical for survival. By the time a trader reaches the point where quitting is tempting, they have already endured enough failure to either break or evolve. This stage is where the difference between eventual success and permanent failure becomes crystal clear. Most traders fail not because they are incapable of understanding the market or executing trades, but because they misunderstand the nature of struggle itself. The market is not a puzzle to be solved once and for all. It is a teacher, relentless and impartial, delivering lessons in patience, discipline, and self-mastery over and over. Quitting at this stage is a failure not of intelligence, but of endurance, and endurance is a skill most beginners have never developed. Frustration at this stage is almost a rite of passage. Losses accumulate, confidence wavers, and the mind begins to manufacture reasons to stop. Maybe trading isn't for me, they think. I'll never figure this out. Each rationalization feels valid because it soothes immediate discomfort. The market does not care about comfort. It rewards consistency and punishes emotional reactivity. The profitable trader views frustration as a signal, not a verdict. They see it as a natural response to growth, an indicator that their boundaries are being tested and that mastery is just beyond the next threshold. It is here that self-doubt becomes a relentless companion. Doubt creeps into every decision, coloring each trade with fear and hesitation. The trader hesitates to enter positions they would have confidently executed a few months ago. They second-guess themselves, abandon strategies mid-execution, and let small losses spiral into catastrophic account damage. Doubt is a slow poison that erodes confidence, and without deliberate mental training, it convinces the trader that quitting is the only logical solution. The survivor, however, learns to accept doubt as a constant variable, not a judgment on ability. They train their mind to act even when uncertainty is high, to rely on preparation and strategy rather than emotional certainty. One of the most insidious reasons traders quit is comparison. In the age of social media, every loss feels amplified, every profit understated. Beginners scroll through curated highlights of other traders' wins, forgetting that these snapshots are carefully filtered realities. They measure themselves against illusions of perfection and conclude that they are failing by comparison. The profitable trader stops looking outward for validation. They track personal metrics, measure growth against past performance, and focus on process, not perception. By removing comparison from the equation, they eliminate one of the strongest psychological triggers for quitting. Impatience is another silent killer. Beginners enter trading with a belief that skill should translate to profit quickly. Weeks without significant gains feel like failure. Losses sting disproportionately because they expect results immediately. Impatience magnifies every setback and shortens the threshold for quitting. The successful trader develops temporal patience. They understand that skill accumulation, emotional mastery, and strategy refinement compound slowly. They measure success in incremental improvement, not in instant gratification. Quitting becomes less tempting when progress is evaluated in long-term terms rather than moment-to-moment results. Financial pressure can amplify the urge to quit. Losses feel more devastating when they impact not just virtual capital, but real-life expenses, bills, or family responsibilities. Every losing trade can trigger a mental spiral that makes surrendering seem like the only option. Yet, profitable traders separate risk and emotion carefully. They trade within limits they can sustain. They understand drawdowns as temporary, and they cultivate a mindset where losses are data, not judgment. Managing external pressure is as much a psychological skill as reading charts, and those who fail to manage it often surrender to the weight of their own circumstances. Overtrading is a symptom as much as a cause. Beginners, desperate to recover losses or chase profits, take trades without discipline. They break their rules, increase size irrationally, and ignore market structure. The result is compounded losses, emotional overwhelm, and the rationalization that quitting is necessary. Profitable traders avoid this trap by maintaining strict rules and seeing overtrading as a failure of discipline, not of skill. They understand that patience is more profitable than frantic activity, and that the market rewards execution, not desperation. Isolation plays a crucial role here as well. Trading is often a lonely pursuit, and without someone to reflect with, errors are magnified in the mind. The trader begins to believe that they are uniquely incapable, that failure is a personal indictment rather than a shared learning process. The profitable trader seeks counsel, mentorship, or community. They normalize discussion of mistakes and process rather than outcome. By removing isolation, they reduce the emotional load and the urge to quit. Trading is never purely technical. It is deeply social, in the sense that accountability and shared knowledge strengthen resilience. The emotional cycle of hope and despair is relentless. After a streak of losses, a win appears like salvation, only to be followed by another setback. This cycle conditions the mind to seek relief in quitting. The survivor learns to detach from individual outcomes and focus on the overall trajectory. They see each win or loss as a data point, not as a measure of self-worth. By decoupling emotion from outcome, they prevent short-term swings from dictating long-term decisions. Quitting becomes irrational when the mind treats each trade objectively rather than personally. Another overlooked factor is narrative. Most beginners create a story about themselves that reinforces quitting. I'm unlucky, I'll never get it, markets are against me. The story becomes self-fulfilling because the mind seeks to validate it. The trader who succeeds actively rewrites their internal narrative. They recognize setbacks as learning experiences, mistakes as temporary, and skills as improvable. They internalize the belief that mastery is achievable through persistence and correct practice, and this mental narrative becomes armor against surrender. Risk perception is a subtle psychological battleground. Beginners often miscalculate or exaggerate risk, either becoming paralyzed by fear or reckless through denial. Both extremes create scenarios where quitting seems like the rational response. Profitable traders develop a calibrated understanding of risk. They quantify it, manage it, and respect it without fear. With proper risk management, losses are absorbed without emotional collapse, and quitting is no longer a necessary escape route. Perhaps the deepest reason traders quit is an inability to handle discomfort. Trading is inherently uncomfortable. Losses sting, uncertainty persists, and the mind constantly pressures for certainty. Beginners avoid discomfort, seeking reassurance, confirmation, or instant relief. The survivor learns to embrace discomfort as a signal of growth. They endure mental tension, prolonged drawdowns, and repeated failure, understanding that discomfort is the companion of skill acquisition and long-term success. Finally, the traders who persist see beyond the immediate horizon. They understand that every session, every trade, every loss contributes to a cumulative skill set that compounds over months and years. Those who quit focus only on the immediate pain, missing the larger pattern. The profitable trader maintains vision, patience, and discipline long after the emotional impulses of quitting have surfaced. They understand that quitting at the threshold of mastery is the ultimate self-sabotage, and that endurance, not luck, determines who thrives in trading. Success in trading is rarely a dramatic event. It is incremental, quiet, and psychological. Those who quit never witness it because they stop too soon. Those who endure transform frustration into fuel, losses into lessons, and pressure into persistence. The market exposes mental weaknesses faster than technical ones. Quitting is the default response for those untrained to endure, while survivors cultivate resilience, focus, and self-awareness. They continue when quitting feels inevitable, and this choice alone distinguishes eventual winners from the countless traders who give up prematurely. Trading mastery is less about strategy and more about mind. The strategies can be learned, the charts can be read, but the mind must be disciplined, resilient, and adaptive. Quitting happens because the mind fears discomfort, rejects uncertainty, and overemphasizes short-term outcomes. Persistence occurs when the mind is trained to endure, to focus on process, and to view setbacks as natural components of growth. Quitting ensures failure. Endurance ensures opportunity. Those who understand this and act on it consistently eventually achieve a level of success that quitters can only dream of. The market is unforgiving, but it is fair. It does not reward impatience or surrender. It does not punish those who persist, learn, and adapt. Most traders quit because they fail to internalize the truth that mastery is a marathon, not a sprint. The few who endure do so because they understand deeply that quitting is a choice, not a necessity, and that their mindset, more than any trade, is the ultimate determinant of success. By the time a trader reaches the 6th stage of this journey, the pain of repeated failure has accumulated into something almost tangible. Every loss, every emotional swing, every moment of self-doubt has left a mark. The mind begins to whisper doubts louder than any signal on the chart, and it feels as though quitting is not just an option but an inevitability. Yet this stage is also where the most critical psychological transformation can occur. The difference between those who ultimately succeed and those who give up forever is not skill, intelligence, or luck. It is the ability to confront their own limitations without allowing those limitations to dictate their actions. Most traders never reach this point because they quit long before. They cannot endure the grinding monotony of repeated mistakes, the slow erosion of confidence, or the daily confrontation with uncertainty. Trading is less about being right and more about enduring when you are wrong. It is about executing a well-thought-out plan over and over, knowing full well that losses will happen, that emotions will flare, and that nothing will ever feel entirely comfortable. Those who quit at this stage do so because they mistake discomfort for failure. They believe that struggle indicates incapability, when in reality, struggle is the sign that growth is imminent. At this point, the psychological toll is compounded by the perception of time. Beginners expect rapid improvement, immediate gains, and clear results. When these expectations fail to materialize, they panic. The market does not operate according to anyone's timeline. It is indifferent, cyclical, and patient in ways that frustrate human impatience. Traders who survive learn to internalize this truth. They recalibrate their understanding of progress, focusing not on instant validation, but on incremental improvements in process, discipline, and emotional control. They measure success by the mastery of their mindset, not the immediacy of their profits. Isolation continues to be a subtle but lethal force. Trading is often a solitary activity, and without external validation or guidance, failures are magnified. The mind invents narratives that reinforce quitting. I am the only one failing like this, or markets are impossible to read. These stories create a psychological echo chamber where despair grows unchecked. Successful traders counter this by seeking communities, mentors, or even informal networks of peers. By sharing experiences, discussing strategies, and validating one another's struggles, they diffuse the pressure that might otherwise compel surrender. Isolation, once confronted, loses its power to break resolve. The trap of emotional attachment to trades is another hallmark of this stage. Beginners become invested in outcomes rather than process. A single losing trade can feel catastrophic, triggering fear, anger, or self-punishment. They begin to overanalyze, overtrade, and chase results that are fundamentally outside their control. The experienced trader learns to detach from individual outcomes. They execute their edge, accept that losses are a normal cost of doing business, and focus on consistency rather than perfection. Emotional detachment does not remove risk, but it neutralizes the impulse to quit under pressure. Financial pressure often reaches its peak here. Losses that impact real-life responsibilities, rent, bills, family obligations, can make trading feel like an untenable burden. Quitting appears rational, even responsible, but profitable traders manage this pressure with foresight. They trade only what they can afford to lose. They separate trading capital from living expenses, and they prepare contingency plans. By managing external stressors, they preserve mental clarity and prevent emotions from dictating the decision to quit. Survival is as much about preparation and risk management as it is about strategy execution. Impatience remains a silent adversary. Beginners often expect skill to convert to profit quickly, underestimating the compounding effect of experience and mental training. They equate a string of losses with personal inadequacy, and each small setback becomes disproportionately demoralizing. Those who endure develop temporal patience. They understand that every trade, every loss, every lesson contributes to a broader arc of improvement. They focus on the journey rather than the outcome, and the urge to quit diminishes when perspective shifts from short-term results to long-term growth. One of the most insidious factors at this stage is cognitive distortion. Traders convince themselves that success requires perfection, that mistakes are unacceptable, and that any deviation from plan justifies quitting. The profitable trader learns to embrace imperfection. They analyze mistakes objectively, extracting lessons rather than moral judgments. They see trading as a continuous learning process where errors are inevitable, and mastery comes not from avoiding mistakes but from responding correctly when they occur. By reframing failure as data, not condemnation, they neutralize the mental triggers that make quitting seem rational. Another challenge is the repetition of mental scripts that reinforce surrender. Beginners tell themselves, "I can't do this anymore," or "I'm just not cut out for trading." These scripts are cyclical. They replay every time losses occur or anxiety spikes. Surviving traders actively replace these scripts with ones that reinforce persistence. This is part of the process. Every loss teaches me something. I can improve through disciplined practice. Rewriting the internal dialogue is crucial because the mind often acts according to the narratives it is fed. Positive narratives cultivate resilience, while negative narratives precipitate quitting. Overtrading is a symptom of desperation at this stage. Beginners attempt to chase losses, justify impulsive decisions, or accelerate their progress artificially. Overtrading amplifies losses, inflames emotions, and often leads to catastrophic outcomes that reinforce the belief that quitting is necessary. Profitable traders resist the urge to overtrade by adhering to strict rules, sizing positions appropriately, and valuing patience over activity. They understand that restraint, not aggression, preserves capital and prevents psychological collapse. The emotional swings are relentless. Wins bring temporary relief, only to be followed by renewed stress from losses. This cyclical pattern conditions the mind to seek escape through quitting. Enduring traders learn to detach from each outcome, seeing individual trades as data points rather than measures of self-worth. They maintain perspective over weeks and months, preventing short-term fluctuations from triggering permanent decisions. Emotional resilience is the foundation that sustains them through the darkest periods of trading. Comparison with others continues to be a dangerous trigger. In the digital age, traders are constantly exposed to highlights of peers' success. Beginners misinterpret curated snapshots as standards and feel inadequate in response. This comparison generates anxiety, envy, and despair, often culminating in quitting. Survivors eliminate comparison as a metric for self-evaluation. They focus on personal progress, process adherence, and incremental improvement. By controlling what they measure, they control their emotional responses, reducing the temptation to surrender. At this stage, the trader begins to appreciate the concept of compounding, not just in profits, but in psychological growth. Each lesson learned, each emotional hurdle overcome, each rule executed successfully compounds into a stronger, more disciplined mindset. Those who quit never experience this accumulation because surrender interrupts the process. Enduring traders understand that the invisible gains in mindset and discipline are as valuable, if not more, than any immediate profit. The mental edge they build compounds alongside their technical skills, creating a foundation for long-term success. Ultimately, the choice to continue or quit is a conscious one, made repeatedly. Every day, every trade, every setback presents a fork: surrender or endure. The profitable trader chooses endurance consistently, not because they are fearless, but because they are trained to act despite fear. They understand that the market does not reward emotion, that skill is developed over time, and that persistence is the most reliable predictor of success. Quitting is the default path, endurance is the learned path, and the few who cultivate the latter eventually achieve the results that countless others abandon before reaching. Trading is a psychological war more than a technical one. At this penultimate stage, most beginners confront the deepest psychological challenges of the craft: fear, doubt, impatience, and the weight of repeated failure. Those who quit succumb to these forces, interpreting them as signals to stop. Those who persist recognize them as markers of growth, opportunities to strengthen mental resilience, and essential steps toward mastery. By enduring, they transform adversity into skill, pressure into insight, and struggle into preparation for lasting success. The market remains impartial, indifferent, and unyielding. It does not accommodate weakness or impatience, yet it rewards those who cultivate the mental fortitude to persevere. Quitting may provide immediate relief from stress, but it guarantees permanent failure. Endurance provides discomfort, discipline, and delay, but it also provides the path to success. Those who understand this, embrace it, and act on it consistently, stand apart from the majority who abandon their journey prematurely. The difference between quitting and thriving lies entirely in the mind.